All right, guys, I don't know if you've been paying attention, but happened to catch my eye last week that the stock market did not have a great month in April, and we will tell you why that matters potentially to your life. Go ahead and put the numbers up on the screen there from CNBC. Dow tumbles more than 900 points, and the NASDAQ drops 4% on Friday to close out a brutal month. So let me read you some of the details here. They say, U.S. stocks on Friday, NASDAQ composite notching its worst month since 2008, as Amazon became the latest victim in April's technology-led sell-off. The tech-heavy NASDAQ fell nearly 4.2%, weighed down by that Amazon post-earnings plunge. The S&P retreated by 3.6%. The Dow shed 939 points, or close to 2.8%. NASDAQ finished at a new low for 2022, and the S&P did as well, with the main stock benchmark taking out its previous low in March. They point to here a couple of things. First of all, they mention Amazon, with a bad earnings report, they lost about 14%, biggest drop since 2006, after reporting a surprise loss and issuing weak revenue guidance for the second quarter. And Amazon, of course, being a global retailer, subject to the same supply chain issues and global forces as everyone else. So when they saw Amazon taking this surprise loss, that seemed to trigger broader losses across the board. And of course, Amazon, being such a giant, just like that loss in and of itself is a significant blow. By the way, Jeff Bezos, his fortune plunged. This shows you how insane his net worth is. His fortune plunged by more than $20 billion just Friday, just during that one stock rout on Friday. The big picture here is nothing that you all will be shocked about. Of course, you've got the ongoing supply chain issues. Of course, you have lockdowns in China contributing to concerns. Of course, you have the war in Ukraine, which is causing all kinds of problems and, again, fueling those supply chain crises. Not to mention increasing issues both with gas, but also with food prices. Then you also have the Fed. Let's go ahead and put this Wall Street Journal tear sheet up on the screen. So they say here, Fed prepares double-barreled tightening with bond runoff. What does that mean? So obviously, with inflation continuing to be high, the Fed has already hiked interest rates, but only by 0.25%, so relatively mild. But the idea is they're meeting this week, they're likely to do a 0.5 interest rate hike, and they are also beginning the process of unloading all of those assets that they have piled up on their balance sheet. Now, you don't need to get into the complicated mechanics of this. However, you should just see this as another way that they are tightening fiscal policy. So in addition to the interest rates increases, which are, they're going at a faster clip now and they're trying to pull back consumer demand, you also have they may not sell off the assets, they just let them run off, but unloading these assets that also contributes to fiscal tightening. So that's probably the big thing that is causing the markets to be spooked right now. And Saagar, as we've covered here before, it is significantly dangerous because we are in uncharted waters with regard to the massive amounts of assets that the Fed has piled up on their balance sheet. And even the experts don't really know what the impact is going to be of allowing these assets to run off. They are also indicating they may even be so aggressive as some of the assets to actually sell, which they have never done before. They didn't do that even in the brief period when they let some of the assets run off before. So they don't know precisely what this is going to do for the economy. Right. So that means that there is a big risk that instead of the soft landing, quote unquote, that they want to be able to engineer, that they're going to trigger a massive crash. Why? Because these assets are massively overinflated. I mean, there's huge asset bubbles. It appears that the stock market continues, even after these declines, to be hugely overvalued. So you have a very, very risky situation ultimately. And the last thing I'll say about this, which I thought David Dayen said quite well, is basically like, you have a supply chain crisis that is fueling inflation. what does the Fed increasing interest rates and curbing demand have to do with that whatsoever? Like,
yes,
that
exactly
doesn't
right.
ultimately solve the problem. It's a very blunt tool. It's effectively the only tools that the Fed has. And since everything else in this town is dysfunctional, that's basically what we have to rely on, and that's a very risky gambit.
Yeah, there's only one organization in America that could fix this supply chain crisis. It's called Congress, and it would have to have a massive industrial project over the next 5 years to both set investor expectations and also fix the structural problems in our economy. Absent that, not much you can do. And, in this article, they say that Jerome Powell was quoted in March saying that this is equivalent to an additional quarter-point bump in the interest rate, which, again, you should all be very concerned about. I think the part here which does concern me, and I don't want to get too much into the weeds, but basically, instead of both a passive runoff, there is a consideration of actively selling mortgage bonds on the open market. Now, what that would be is it would actually raise the mortgage rates, and borrowers would be less likely to refinance into a new loan. Thus, they would be slower to mature. So it would be, in effect, an ability in order to push the mortgage rates even higher than they currently are. Now, my concern on that would be, look, I think that the mortgage rate already has risen more than any time in modern American history. That's kind of nuts. I mean, we went from 2% to 5% in the span of a single year. Now, that's obviously going to slow down the market. Let's say mortgage rates get up to like 7%. Now you're in a situation where you're actually going to be increasing a rent crunch because people who were going to buy are not going to borrow at a 7% interest rate.
Right.
Well, guess what, guys? We already have a 21% inflation when it comes to rent in a single year. I was talking with some people who were in Idaho and in Arizona. Both of those places are seeing double-digit, like 40% rent increase in some areas because of the runoff from California, Austin. I got friends moving to Austin very soon. The rent increase and mortgage increase and price there is in a world that you cannot even conceive of. In terms of houses there were already selling $300,000 over asking price. Now, I'm not saying that that's a good thing, but we could be obviously in a situation of overcorrecting. And with all of these blunt tools, and especially with our financialized economy, you have no idea how this is going to play out. And what do we always warn people? You may not make money on the way up, but you're going to lose money on the way down.
You're going to get
because
on the way down.
If there is a crunch, that means that it's harder to make payroll, it's harder for businesses to take out loans, it means more firings, means more macroeconomic conditions that make unemployment more desirable, which literally, this quiet part out loud when they say they want the economy to tighten or to slow down is they want higher unemployment because unemployment right now is like 3.9%. So that's a real disaster for a lot of people who are out there.
That's it. What the Fed can do is basically make it so you have access to less money.
There you go.
Mean, that's when we use all this fiscal tightening and all this. That's what it actually means.
It's a euphemism.
That's what it actually means. And so it's effectively of course, inflation is a massive problem. I mean, inflation at the level we have right now means that workers are taking a pay cut every single month. Like their wages are going down every single month. And obviously that cannot persist. But when we just rely on the Fed, that's how we got into this problem to start with, is that we have over-reliance on the Fed. And so we leaned on them to basically backstop the entire economy. And by the entire economy, I mean the entire Wall Street economy, because that's all they can really do without some novel and creative approaches, which we can, debate with an expert on another day, what might actually be at their disposal. But in terms of the tools that they think are available to them, that's all they can do. And so when you over-rely on the Fed, they can shoot trillions of dollars at Wall Street. They can make sure that, the stock market is completely buoyed. They can make sure the bond market this time is also completely supported and risk-free. Can they actually fix the real economy and iron out these issues with the supply chain? No. And so you have a terrible potential scenario where they are acting to slow the economy and make sure you have less money in your pocket to, and available and access to in order to spend. But the inflation, the things that are causing inflation don't actually abate.
Yeah.
So you continue to have these high levels of inflation even as you're triggering a recession. I mean, that's a very real possibility that's on the table. And again, because we've never quite faced this exact scenario with combination of, interest rate hikes plus runoff of the assets on the balance sheet, plus potentially even selling off some of the assets on the balance sheet, there is no one who knows exactly what that is going to mean ultimately for the economy. So yeah, they may say it's probably equivalent to another quarter point increase. That might be true. It might be less than that. It might be more than that. These are all like educated guesses as to what it's actually going to mean for the economy. There was one other piece here that I wanted to share with you. So there's another analyst who's predicting a massive stock market crash. Let's go ahead and put this insider tear sheet up on the screen. They say a notorious market bear who called the dot-com bubble warns there's a strong possibility of a 50 to 70% crash ahead and breaks down why stocks are primed for a decade of dismal returns. Now, let me say, this guy, his name is John Hussman.
Yeah.
He's the president of Hussman Investment Trust, and he is a little bit of a perma bear. And he has been predicting a crash for a while now, and obviously hasn't come to fruition. However, on certain, his track record outside of that is actually very good. He predicted in March of 2000 that tech stocks would plunge 83%, and lo and behold, the NASDAQ index lost exactly 83% during a period from 2000 to 2002, so he kind of nailed that one. He predicted in 2000 that the S&P would likely see negative total returns over the following decade, and then it did. He also predicted in April 2007 that the S&P 500 could lose 40%, and then it proceeded to lose 55% in the subsequent collapse. So he does have some record of correctly calling crashes in the past. He looks at, whether markets based on his calculations are overvalued, and he effectively looks at the markets even after these declines and says they are still massively overvalued. And the real key here, I'll just read what he says. He says, the main thing that determines whether an overvalued market continues to advance or drops like a rock instead is whether investor psychology is inclined towards speculation or risk aversion. When investors are inclined to speculate, they tend to be indiscriminate about it. When investors become risk averse, they tend to be skittish and selective. Such sentiment is already here. According to one weekly survey of investors, sentiment is at its lowest point since 2009. It's kind of a funny thing to measure, sentiment, but that's that's why he thinks he's issuing this dire warning about what could be coming next.
Yeah, I think that in general, everyone should be very on the watch. The S&P 500 is down, I think, 14% year over year, which is not obviously the norm. We've had a decade of mega growth. And actually, in Silicon Valley, I think I referenced this previously. I spoke with David Sachs. He's a venture capitalist. He was saying in some of the private markets, you have VC valuations dropping down by 70-something%, which is that has a major ripple effect on capital in the private markets, which then obviously is going to bleed into the public. So if the publics are down this much, imagine what private valuations, and remember, people take huge loans and margins based upon the valuations of their business. This also impacts the type of technology and other stuff that gets invested in the middle of a bear market. So it's very possible after a decade of growth that we could be entering a decade of decline. And my biggest fear is a true return to the 1970s, which is if they tighten and we still have high inflation via the supply chain crisis and we have high unemployment, you have straight up stagflation all over again. Not to mention a gas crisis. It's like you can't make it up in terms of how it that situation was so traumatic for an entire generation of people. It impacted fiscal policy for 2 decades.
Yeah.
We could be back in that situation again.
Yeah, it was so dire because now Paul Volcker, who was the chairman of the Fed then and who, just decided I'm just going to lift interest rates until inflation stops. And he did that and it was extremely painful. And I feel like some of that pain gets lost in the telling of the Paul Volcker
don't really remember
hero
that.
narrative.
Yeah.
But it was so bad. You had, farmers who were going bankrupt who literally drove their tractors up to the Federal Reserve building. It was an intense period of financial and economic pain that was far from just confined to Wall Street. So that's why we're kind of trying to stay on top of, what the Fed is doing, what it means, how investors are reacting, because I think it's undeniable that, the markets have been dramatically overvalued. They've been pumped up by the Fed and, their backstopping of the entire thing. And so the question is just, is the music going to stop and the whole thing collapse, or will they be able to actually engineer this soft landing that they are trying to pull off in very difficult circumstances?
Yeah, that's
TBD.
right.
Cable news is ripping ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.